Hello everyone, welcome back to Market with Mahesh. If you're planning to trade Nifty next week, this video will help you prepare. We'll review last week's market action, analyze the daily chart, study option data, and discuss the key support and resistance levels to watch. Let's begin. The Indian stock market witnessed another weak week, with sellers dominating most trading sessions. Heavyweight sectors continued to face pressure, while volatility remained elevated. Although there were recovery attempts, every rally attracted fresh selling, indicating that market participants are still cautious. With quarterly earnings, global cues, and FII activity expected to remain in focus, the coming week could witness higher volatility. The US Fed will announce its interest rate decision on July 29th. Quarterly results from Larsen & Toubro, Tata Motors, State Bank of India, Maruti Suzuki, ITC, and Ultratech Cement will be closely watched by investors. The July monthly expiry of Nifty and Bank Nifty futures and options on July 28 is expected to keep market volatility elevated. On the daily chart, Nifty is trading inside a large symmetrical triangle, showing that the market is consolidating as buyers and sellers battle for control. The index is now testing a crucial support zone between 23,636 and 23,767, where both the horizontal support and the rising trendline come together. This makes it an important level to watch. From a technical perspective, Nifty is trading below the 9-day exponential moving average and around the volume-weighted average price, suggesting that short-term momentum remains weak. If the index manages to hold above the 23,600 to 23,700 support zone, we could see a rebound towards the upper boundary of the triangle near 24,400. However, if Nifty breaks below 23,600, the bullish structure would weaken, increasing the possibility of a decline towards the 23,200 to 22,400 zone. Let's understand what the option chain is telling us. On the downside, significant put open interest is built around 23,500 to 23,700. This suggests that many traders are expecting Nifty to hold above this zone, making it an important support area. However, the highest put open interest is at 23,000, indicating that if selling intensifies, option writers believe 23,000 is the strongest support for this expiry. On the upside, the highest concentration of call open interest is between 24,000 and 24,200, which makes this the first major resistance zone. Beyond that, 25,000 has the highest call open interest, suggesting it is a strong ceiling where sellers are aggressively positioned. Let's understand what the participant-wise derivatives data suggests. If you closely examine the changes from Friday, you'll notice that foreign institutional investors, FIIs, added 7,765 fresh short positions in index futures, taking their total net short position to 270,847 contracts. This indicates that FIIs continue to maintain a bearish stance in the index futures segment. Although domestic institutional investors, DIIs, appeared to be buyers in the cash market, their derivatives positioning tells a more cautious story. DIIs continue to hold a significant net short position of 3,904,944 contracts in stock futures, suggesting that they remain heavily hedged despite cash market buying. Another interesting observation is that domestic institutions were relatively inactive in the options segment. As highlighted by the orange marked section in the table, their options participation was comparatively low, indicating that most of their positioning remained concentrated in the futures market rather than through options. As far as Friday's options data is concerned, we did observe a noticeable round of short covering after 10:30 am, which is clearly visible in the yellow marked section of the table. This suggests that FIIs and proprietary traders reduced some of the bearish positions during the session, contributing to the intraday recovery. However, this short covering should not be interpreted as a complete shift in market sentiment. Since FIIs continue to hold a sizable net short position in index futures, the broader positioning remains cautious. Therefore, Friday's intraday move appears to have been driven more by profit booking on existing shorts than by the establishment of fresh bullish positions. These are the important levels and option data that I'll be tracking for the upcoming week. Let me know your view in the comments. Are you bullish, bearish, or expecting a range-bound market? If you found this analysis useful, don't forget to like the video, subscribe to Market with Mahesh, and press the bell icon so you never miss a market update. Thank you for watching, and I'll see you in the next video. This video is for educational purposes only and should not be considered investment or trading advice. Please do your own research or consult your financial advisor before making any investment decisions.